All right, let's take a look at comparing net incomes under absorption costing. This is more so dealing with different levels of production, and even though you sell the same number of units, that level of production actually can affect your reported, cost of goods sold, and therefore your net income. And there's some drawbacks to that. So let's read through the question. We'll go through it and explain kind of the perils of absorption versus variable costing. So a manufacturing company incurs the following costs during the month of August related to production. So they had direct material per unit of $8, direct labor of $6 per unit, variable manufacturing overhead of $2 per unit, and total fixed manufacturing overhead of $18,000. Again, all of this was during the month of August. The company expects to sell 10,000 units at a price of $30 per unit. If variable selling and administrative expenses are 50 cents per unit and total fixed selling and admin expenses are 8,000, what is net income at production levels of 10,000 units and 12,000 units? If management compensation was tied to net income, which production level would the manager choose to operate at? Is this good for the company? Assume they follow absorption costing. And the hint I give here is to prepare, a traditional gross profit income statement at each production level. So let's take a look at that solution. We'll get into the weeds of it here in a minute. The first thing we have to do, though, is calculate the fixed manufacturing overhead. And you're going to have two separate fixed manufacturing overhead amounts at each production level because you're obviously producing a different amount. You're incurring the same fixed manufacturing overhead, but you're producing at two different levels in this scenario. So at a production level of 10,000 units, we get a fixed manufacturing overhead per unit of approximately $1.80. Obviously, that number is going to go down on a per unit basis if we produce more. In this case, if we produce 12,000 units, we get a fixed manufacturing overhead of $1.50 per unit. Now, remember, the idea here is that they are utilizing absorption costing. So absorption costing, our product cost or cost of goods sold, what's going to go into that number, it's direct material, it's direct labor, it's variable manufacturing overhead, and it's fixed manufacturing overhead. All the other costs do not fall into cost of goods sold and therefore are not product costs under absorption costing. They would fall below the gross profit line. So let's first focus on how do we come up with operating income at 10,000 units produced. And like I recommended, to prepare an income statement, a gross profit income statement. It doesn't have to be fully extensive, but this is sufficient. Sales, that's an easy one. The number of units sold, I believe in the question, SEM says they sold 10,000 units. Each unit was sold for $30 a piece, so they're going to generate sales revenue of $300,000. That's not going to differ for 12,000 units produced or 10,000 units produced, since we're dealing with the number of units sold, not produced there. Cost of goods sold, how do we get that? Well, remember, under absorption costing, it's direct material per unit plus direct labor per unit plus variable manufacturing overhead per unit plus fixed manufacturing overhead per unit, and then all of that times units sold. I'm just gonna make that a little clearer to see. So if you look at the formula here, our direct materials per unit was $8 a piece. Our direct labor per unit was $6 per unit. Variable manufacturing overhead per unit was $2. And for this activity level of 10,000 units produced, we calculated fixed manufacturing overhead to be $1.80. All that multiplied by the units sold, which was 10,000 units, we get a cost of goods sold of $178,000. Then from there, it's pretty straightforward. We subtract the two, sales minus cost of goods sold, to get our gross profit. Our variable selling and administrative expense, how did we calculate that? Well, we took the variable selling and administrative expense per unit, which was 50 cents, and we multiplied by the units sold, which was 10,000, to get 5,000 in variable selling and admin. Fixed selling and admin, it's just a fixed amount. In the month of August, they incurred $8,000 of it. So that's simply put. To calculate the operating income at this activity level, we take the gross profit of $122,000 and we subtract out both the variable selling and admin, and the fixed selling and admin. We get an operating income at this level of $109,000. Now you might be wondering, why would income differ if we're going to increase production? Why is that the case? The income statement only deals with the units sold. Well, you are right in some sense. The income statement does deal with the units sold, but the difference under absorption costing ties back to this calculation we did up here. Fixed manufacturing overhead per unit for 10,000 units produced was $1.80. However, if we produce 12,000 units with the same fixed manufacturing overhead, we're spreading out that fixed manufacturing overhead over more units. Therefore, that drives down our fixed manufacturing overhead per unit. And as you can see, our numbers are going to change just the slightest. Now, what doesn't change, obviously, is sales. Sales is still going to be 300,000 because it's simply the number of units sold times the sales price of $30. The only difference, or the first difference, I should say, for our income statement at 12,000 units produced is the cost of goods sold. We follow the same formula. It's direct materials per unit, which was $8, plus direct labor per unit, which was $6, plus variable manufacturing overhead was $2. So those numbers stay the same. What differs is now we're using the fixed manufacturing overhead per unit at this activity level, which we calculated to be $1.50 per unit, not $1.80 like it was at 10,000 units. Because of that, that drives down our cost of goods sold from 178,000 to now 175,000. So there's a $3,000 difference there. Because of that, you'll notice now gross profit is higher by 3,000 under this activity level, and our bottom line is higher by 3,000 at this activity level. So in this scenario, if we just looked at this information here, if we just look at the income statements for this department, it's clear that we should produce more because it drives up our income. But I want you to step back and look beyond the numbers and ask yourself, from an operations or strategic business standpoint, does that make sense? Or what do you have to consider? Well, from a number standpoint, it makes sense because income goes up. The issue is now, though, we have produced 2,000 additional units. The problem with inventory, as you've read in the book and as you'll hear me say on and on, inventory is a necessary risk for a company that is a manufacturer or a retailer. That's obviously how they make their money. But with inventory, there is a lot of risk because it does tie up your capital. It costs money to produce or to purchase, and it's not the most liquid asset that you can have. And the additional risks, you have to store that inventory. So there's the increased cost related to storing additional inventory, to protect it, to safeguard it. There's the chance of theft. There's the chance of it being damaged. There's the chance of it becoming obsolete. If that inventory sits around for too long, it might no longer be relevant in the market. And now all that money you spent on that inventory is gone, or you're going to get pennies on the dollar back for it. The whole point of this exercise is to show that with absorption costing, if I'm evaluated on my department's bottom line, if I'm the manager of this department and I'm evaluated just on this metric, let's say operating income, what is that going to motivate me as a manager to do? That's going to motivate me to produce as many units as possible. Therefore, I am driving down my fixed manufacturing overhead per unit, which drives down my cost of goods sold, which increases my gross profit and ultimately my bottom line. Is that good for the business as a whole, though? Maybe it is, but maybe it's not, because me producing these additional 2,000 units, I better hope that there's actual demand for those 2,000 units, because if not, now I've just wasted the production costs related to 2,000 units all because I was trying to maximize this bottom line. So there is risks and potential for earnings management with any sort of costing system. This is how you would do that under absorption costing. So you have to be wary of that.